right. I see that people are still joining the Zoom room, but we'll just get started with the logistics item. Again, good morning and good evening, everyone. Welcome. Thank you so much for joining us today as we're having this discussion around the critical topic of financing the zero-emission truck transition in India. This webinar is co-hosted by RMI and COSET, the Center of Excellence for Zero-Emission Trucking at IIT Madras. My name is Zhinan Chen. I'm a senior associate at RMI's India program, working to decarbonize India's freight sector, and I'm one of the co-authors of the report that we'll be launching today. A few quick housekeeping remarks. This webinar will be recorded and we'll upload the recording to RMI's event page, which you use to register for the event. We'll also be actively taking Q&A audience questions throughout the whole session. So if you could look at the bottom of your Zoom screen, there's a Q&A box, which you can use to enter your questions. And we'll try to answer as many as possible at the dedicated Q&A session at the end. In terms of what you're expecting for today's session, we'll be first hearing the opening remarks from Ms. Akshima Gate, followed by a very detailed presentation on key findings of the report that we'll be launching today. Afterwards, we'll be dedicating about 50 minutes to an expert panel discussion around real-world insights in mobilizing zero-emission trucking finance. And then we'll move on to the Q&A session and we'll conclude the webinar. Now, let me welcome Ms. Akshima Gate, Managing Director at RMI, who's overseeing the India program and one of India's leading experts on clean mobility. Akshima will be giving her opening remarks. Akshima, the floor is yours.
Thanks, Janan. A very warm welcome to all of you, and thanks for joining us your morning or evening today. As Janan mentioned, we are gathering all of you today to discuss a very critical topic of transitioning to zero-emission trucks. Particularly in this webinar, we'll be focused specifically on the challenges that are related to financing the transition to zero-emission trucks. I think there is no doubt most of us will agree that as India is striving towards its ambitious net zero goals, the transition to zero emission trucks will be very, very critical. We recently launched a report which lays down a roadmap on how India can really decarbonize or achieve energy independence by 2047 in its mobility sector. And one of the biggest takeaways for us has been that this transition towards energy independence or net zero or towards a future which is really clean energy future for the mobility sector in India cannot be achieved if we do not transition the current trucks to zero emission trucks in India. The trucking sector significantly, beyond just contributing to the energy consumption and carbon is also a key contributor to air pollution. And even from a public health perspective, it becomes very, very critical that we mobilize this shift towards zero emission trucking technologies in the near future to begin with. However, what we are also realizing that this technology in terms of its, it being tested, piloted and being on road is very, very nascent. There are substantial challenges, hence that we see that will emerge in terms of how really this transition will take place, and more importantly, how will the financing of this transition really happen? Because it's a very, very emerging market, which will make it very difficult for for the investors to really evaluate the risk, the residual values, and the returns compared to a very established technology today in the market, which is the diesel trucks. What we are realizing is that to support such a widespread adoption of zero-emission trucks as is desired in very ambitious and aggressive scenarios of energy transition, financing will, however, be very, very critical. We will have to start now, even if the market is nascent, it's an emerging technology. We will, nevertheless have to start now and create tailored financial strategies and investments. This will not only include, financing of Z manufacturing and procurement, but would also need financing for developing and deploying, requisite charging infrastructure for charging zero-emission trucking trucks deployment, and the necessary grid upgrades, which we realized will be very, very significant for supporting charging of zero emission trucks. In today's webinar, we thought that we will bring together a diverse group of participants from industry, from academia and think tanks, which has been working on this topic of mobility decarbonization on zero emission trucks, to really, one, from our end, share insights, and also to hopefully hear from you in the Q&A session on how you think about this transition with a specific focus on financing. Financing will be our focus today, as we said earlier. We are hoping that we can explore how investments across the entire ZET ecosystem, from purchasing and manufacturing of ZETs to deploying charging infrastructure for grid upgrades, all of that really can be tailored and developed over the next 2 to 3 years, so that we can really close the cost gap with the diesel trucks, which is the existing technology. And hopefully this should help us drive the market demand and also unlock private sector investment. Over the last year or so, our team has been partnering very closely with Center of Excellence on Zero Emission Trucks at IIT Madras. And we've been engaging several groups, stakeholders in discussions and conversations. We've conducted nearly 50 interviews with the ecosystem players with a specific focus on financing community to identify the pathways for financing this transition. We are hoping that whatever we have learned, we can share that with you all. We'll also be launching, as Anand mentioned, a report which actually brings all of this together. So I'm very excited that we will be launching that today and also presenting that to you later in the webinar. In the conversation today, hence our focus really is that we can share our key findings, whatever we have learned over the last 1 year in terms of financing a very nascent electric vehicle technology, but also very, very critical EV technology. So we are hoping that we will share those insights on financing mechanisms and de-risking strategies that can really help us close the cost gap between zero emission trucks and diesel trucks, and hopefully that will lead to driving of demand and investment. We're also hoping to share some of the very specific, immediate actions that we've outlined in our report, which are specific to institutions like multilateral development banks, DFIs, and also a government agency to really kickstart the ZET financing and create a very clear roadmap around that. We're also hoping, though webinar is usually not such a friendly format, but we are still hoping that we can foster connections and create a lively platform for dialogue, which from our end, helps us share, but also helps, bridge information gaps and hopefully build a consensus on the financial tools which are needed to accelerate the ZET adoption. I'm very thrilled, as I said earlier, to launch 2 reports that we have developed over the course of last 1 year. The first report, it's titled Outlook on Zero Emission Truck Financing in India. It is really from our end, packaged as an executive brief, which will highlight the vital role of financing tools in accelerating ZET adoption. Our second report, it's titled Comprehensive Guide to ZET Financing. This report will provide a very in-depth exploration of the financing landscape and offer a detailed roadmap for all ecosystem participants. We are here outlining steps for developing financing instruments, implementing de-risking strategies, and creating tailored business models for the ZET sector. We are hoping that these 2 reports, by way of design, will complement each other. On one hand, it's an executive, kind of a package where we are specifically highlighting actions for policymakers. On the other hand, we are having a very, very comprehensive guide for the entire ecosystem. So we're hoping that these 2 reports will complement each other, recognizing that there will, at the end of the day, be need for a very strategic mix of innovative financial tools that will be needed, on which ecosystem players really would have to come together. We are also in the reports highlighting the importance of supportive de-risking practices and very, very ZET-specific business models. Again, we strongly feel the ecosystem will have to come together to create such innovative business models and really establish in the next 2 to 3 years what we feel will be the foundations for a much more scaled uptake of ZETs, to come up in the years to come. With these recommendations in these reports, we are really hoping that financing of ZETs can become a mainstream topic, that as this segment really picks up. We are not ignoring financing. Like, previously we've done for some segments that financing has come much later as a conversation. So we're really hoping that it doesn't play a catch-up game, and we can start these conversations and hopefully, start crafting solutions together as part of the ecosystem. So once again, thank you for being here, and I'm hoping that we can really create a very lively conversation today. Back to you, Jana.
Thank you so much, Akshima, for your encouraging opening remarks and for launching the two reports. I'm sure we're all very excited to get a glimpse into what's actually in these two reports. So now let me welcome Ms. Marie McNamara, manager of RMI's India program and one of the co-authors of these two reports, to share with us some of the key findings. Marie, over to you.
Thank you so much, Janan. If you could go ahead and go to the next slide. Terrific. So throughout this engagement process, when we have been interviewing stakeholders to really assess the opportunity for financing the zero-emission trucking transition, we've landed on a broad theory of change. And this is the need for financing tools to physically fund this zero-emission truck transition, and then the need for complementary business models and de-risking practices to enable and better manage this shift. So today in this presentation, we're going to go through in detail what these financing tools are, how they can be applied to the zero-emission trucking ecosystem, and how complementary business models curated to the zero-emission trucking market and ecosystem enablers and de-risking practices can accelerate this adoption and enable financiers to have confidence in lending to mobilize this transition. Go ahead and go to the next slide. So when we're thinking about the zero-emission trucking transition, we have been very cognizant to think about it as a holistic ecosystem. There's a need to fund the manufacturing of these vehicles, the purchasing of these vehicles, the requisite charging infrastructure, to have a robust network to operate these vehicles within, and the need for grid upgrades to be accompanied with this in order to manage the charging loads. And so as we were thinking about the financing tools of concessional debt, equity, risk sharing, and credit enhancements, and viability gap funding, we've thought about how those financing tools can be applied to these distinct but related market segments of manufacturing, purchasing, charging infrastructure, and the grid. And we've thought about recommendations to curate these tools to support the development of these critical market areas. And we've also thought about this transition as something that's very fluid. And there's going to be a need for curated financial tools to incubate and drive research and development in this space. And then there's going to be a need to tailor these tools to then drive scale. So if you go to the next slide, I will now describe the financing tools that we think are highly applicable to the ZET market. So the 4 tools that we really see having an outsized role in shaping this transition are debt, risk sharing, facilities, and equity and viability gap funding. So concessional debt is below market rate financing provided by lending institutions. This is critical as we know that the price of debt today is seen as by many market actors as too high or not affordable because there is an interest rate premium charged on zero-emission trucks because of the perceived and real asset risk. And basically what that means is because ZETs are a new technology as other nascent markets, there is a perception that and there's a lack of track record in terms of their operations. And so financiers are finding it challenging then to offer the same kind of interest rates and loan tenors as internal combustion engine vehicles. And so concessional debt offered by multilateral development banks or public institutions can come in to offer this, can really help unlock this, providing debt that is more affordable to spur this transition. Then we're also seeing globally that green bonds are very instrumental. Then the next one in debt is commercial loans. So there is a need for ZETs to have asset-based financing. And so we'll discuss this more in detail, and the report also provides more detail, but there is a need to provide vehicle loans to enable this transition. Then we have risk-sharing facilities, and this is how can credit enhancements be used to help mobilize lending within this space. And this is basically financial coverage provided to a lender in case there's a loss. So in a guarantee agreement, the financer would receive some assurance from the guarantor that in case a ZET is defaulted on, they would not be liable for the full loss and there would be some coverage. This is really critical, especially when the residual value of zero-emission trucks is largely unknown and not realized in the market. So this helps financiers have assurance that in instance of loss, they can recoup some of this back, and it helps reduce risk. Then you have concessional equity. We've seen this start in the EV ecosystem, and this would be pertaining to equity with return expectations that are lower than typical in markets. And then finally is viability gap funding. This can be in the form of government budgetary allocations, and it is incentives and grants as to help kind of bridge the gap between the purchase price between zero-emission trucks and diesel trucks. So if you go to the next slide, we've described how these financial tools can be implemented. So I will just focus on a couple critical pathways that we see, and I encourage you to read more details in the insight brief that highlights how we could envision a implementation pathway and what stakeholders can do. So for loan guarantees, development finance institutions like the Small Industries Development Bank of India can, with support from multilateral development banks and or philanthropists, can support in setting up risk-sharing facilities for zero-emission trucks. In the Insight report, we draw on the existing SIDBI Shell foundation facility that has been developed for electric vehicles to think about the loss coverage that would make sense for the zero-emission trucking ecosystem. And we encourage ongoing collaboration and discussions from participants about what this could look like. We've tried to detail in the report implementation pathways that we could see, drawing off best practices. Another one that I want to emphasize is for charging. The Ministry of Heavy Industries can provide a one-time grant for the development of public charging projects to offset the revenue to cost gap incurred by charging point operators. What we're seeing is for charging infrastructure, the capital costs are quite constraining in terms of deploying high-powered and expensive charging assets. But with sustained utilizations over time, there is viable revenue flows from charging, and so these operators can recoup operating expenses. There's just a need for intervention to help unlock the capital costs that it takes to deploy these. And last but certainly not least, we've highlighted solutions for requisite grid infrastructure. When we're thinking about charging clusters around critical corridors to provide seamless en route charging, this will require in some extent, some requisite grid upgrades in the form of transformers and line extensions. And there's a need for central financial assistance through grant allocations to support in the deployment of such infrastructure. And so that would be one of the solution pathways that we see for that. If you could go ahead and go to the next slide. So This is a visual highlighting then how these financial tools can have an actualized impact on the total cost of ownership of trucks. This exhibit shows how a blended finance approach, which is basically the use of debt, equity, risk-sharing facilities, and government budgetary allocations, can narrow the TCO gap. Today, we're seeing that ZETs have a 20% more their TCO is 20% more than diesel trucks. But after financing interventions, ZETs can achieve a slight TCO advantage. Such interventions can be pared back as the ZET market reaches economies of scale, with capital costs continuing to fall in primarily due to battery declines and the ability for manufacturers to, once there is volume in terms of demand, they can then dedicate production facilities and lower the unit per cost of these trucks. So we want to emphasize that TCO superiority for ZETs is very important, as in order to invoke a shift, actors will need to see a benefit to adopting zero-emission trucks that is quantifiable, and in order to take on the new risk in terms of what the ZET transition is. In the comprehensive report that we have linked, we go through the risks extensively for zero-emission trucks, as we have tried to portray how these financing tools can address such risks. These risks are asset risks that stem from uncertainty in how the zero-emission truck will perform, its range, the ability to charge. It also pertains to business model risk, which is the ability to sweat the asset in order to have the operational cost savings that are needed to reach TCO parity with diesel vehicles, because ZETs today, quite frankly, do have a higher purchase cost, and the real opportunity is in their cost savings over time. And then the last is customer risk. We know that a lot of zero-emission truck operators are small fleets with 5 or less trucks. And so there's a need for familiarity in terms of banking for these sometimes new to credit customers. So if you could go to the next slide. Terrific. I see that it's loading a bit slowly. Oh, here we go. So in offering some conclusions, in addition to financing tools, there's a need for complementary de-risking measures. These are ecosystem-wide enablers that can help unlock this market and better manage the risks that are persistent. 2 that I just want to highlight are demand aggregation. As demand aggregation can help achieve economies of scale and provide assurance to manufacturers that there will be a procurement at the end of them investing substantially in research and development. And corridor development. We see corridor development as an opportunity to manage the challenges associated with low charging utilization and to strategically invest in charging assets around a highly utilized closed loop system. We think that demand aggregation and corridor development are actually quite complementary de-risking measures, and urge you to take a detailed look at the report. If you could go to the next slide, please. Business models curated to the zero-emission trucking market are also critical. Leasing is a simple yet effective way for driver operators to transfer the risk of ownership and residual value risks of zero-emission trucks to a larger leasing or NBFC platform. Mobility as a service contracts, where it is a bundled approach of offering charging, battery as a service, and or fleet management services, is also a very effective means to transfer risk to a business organization that has made it their entire operations to focused on zero-emission truck management and the risks that are a part of that. Warranties need to be developed, particularly for batteries themselves, so that operators can have confidence that if there is an issue with a battery, that they will be able to cover a replacement within a period of time. And insurance is also critical. This would be additional, not binding, comprehensive insurance covers that is designed for the zero emission trucking ecosystem. If you could go to the next slide, please. So these will be the final remarks, but actionable steps are needed by all parties. The government can play a key role in building confidence into this market, offering incentives and providing grants to spur this transition. We've outlined here critical activities that differing ministries can take up. The Ministry of Finance arguably has a very important role to play in offering sovereign guarantees for the development of risk-sharing facilities. The Ministry of Power has a critical role to play in helping mobilize the debt needed to provide requisite transformers for this transition. Philanthropists can play a support by providing concessional financing for the development of risk-sharing facilities and forming strategic partnerships. Multilateral development banks can play a critical role building on their expertise as a financer and through the deployment of risk-sharing facilities. And local finance institutions have a prominent role to play in terms of offering commercial debt products and thinking about innovative ways to develop longer tenures for zero emission trucks in order to finance this transition. If you could go to the next slide, please. The private sector can then work in tandem, offering business models that are curated to the zero emission trucking market. I've already spoken about some of those, but fleets, OEMs, charge point operators, technology operators, insurance providers must work in tandem to deploy ecosystem-wide de-risking measures. And this slide presents actionable opportunities in the near term that can really drive substantial change. And the final slide is that financing tools coupled with de-risking practices and ZET-specific business models is really a comprehensive strategic model to mobilize that financing. We see these interventions as harmonious, and differing public and private actors have an obligation and are strategically placed to implement such actions. Again, this was just brief remarks of this report. We really urge you to take a look. We think that this is just our first chapter of doing this research and welcome conversations, and would love to hear your inputs about some of the actions that we've elevated in these reports. We think that this will take an iterative process among stakeholders, and we hope that these reports offer a foundation for how to think about the deployment of these opportunities. So with that, I'll conclude my remarks, and I very much thank you for your time.
Thank you so much, Marie, for the very thorough and insightful presentation. I'm sure we're all very curious to learn what are the on-the-ground implications of all these finance tools, business models, and de-risking measures that Marie, you just presented. So now it's a perfect time to transition into our expert panel discussion, which will be moderated by Ms. Samhita Shilidhar, Director of Global Transportation Programs at RMI. Over to you, Samhita.
Thank you so much, Jinan, and thank you so much, Maria and Dakshima, for setting the context for today's panel discussion. Good morning, afternoon, evening, everyone, depending on where you are. Welcome to today's panel discussion on a very important topic when it comes to transport decarbonization in India, which is financing the transition to zero-emission trucks. My name is Samhita Shilidhar, and I'll be moderating today's panel. Today, we'll explore the financial strategies needed to make zero-emission trucks a reality, focusing on how various key players, right from multilateral banks, private lenders, financial institutions, and industry players, can contribute to this critical transition. Before we get started, let me briefly outline the format of the panel discussion. We'll begin with general question for all of our panelists, followed by more specific questions to each speaker. And towards the end, we'll also open the floor for audience Q&A. So please take an advantage of the chat function, Q&A function with Zoom, and add your questions up there. We are thrilled to have a very distinguished and diverse panel with us today, bringing together deep expertise across various vital sectors within zero-emission trucking transition. First of all, we are joined by Jayant Prasad, Executive Director of Seekers Finance. Seekers Finance is a specialized sustainability finance company that operates in a rapidly growing segment around sustainable energy. Jayant has played a pivotal role in creating innovative financial tools for EVs and is recognized leader in the electric mobility financing ecosystem. Next, we have Saurabh Sood, Senior Transport Specialist from the World Bank. Saurabh is a thought leader in infrastructure strategy, policy, as well as financing sector, and his experience includes developing financial models that support the transition to zero-emission trucks. And finally, I'd like to welcome Samir Agrawal, founder and CEO of Refin. Refin is revolutionizing India's sustainable mobility ecosystem with cutting-edge EV financing solutions and a thriving ecosystem. Samir is deeply engaged in financing middle-mile zero-emission trucking use cases and is also the president of Electric Mobility Financiers Association of India, a key expert driving finance solutions for electric mobility ecosystem. Welcome all of the participants. All right, so I would like to get started with a question that has significant near-term implications for accelerating the market. So for that transition to take hold, it will be critical to reach economies of scale to lower the price of zero-emission trucks and reach specific charging utilization levels. So my first question to all of the panelists is, what innovative financing tools can work to fund the deployment of first 10,000 Zs in India, along with the requisite charging infrastructure? And I'm saying 10,000 as a baseline that could represent an initial and targeted outlook to increase the zero-emission truck sales over the next years. So my question to all the panelists is, what innovative financing tools can work to fund the deployment of first 10,000 Zs in India? Let's start with Jayant.
Thank you, Samita. Am I audible?
Yeah.
Okay, perfect. So as seekers, we have been funding the climate transition, and this is the kind of problem we have dealt with initially in our evolution. First with rooftop solar, where we participated in distributed rooftop solar financing, and then with electric vehicles in the two-wheeler, three-wheeler form factor. And each time we go into a new segment, we address this question that, how does the first 10,000 or equivalent vehicles get deployed, which creates the base of validation of product proposition, the value prop. It creates the referenceability for other buyers in the market, right? And it also creates for us the learning as financier, the learnings around what use cases are starting to converge and which are still a little far off. And then that allows us to convert this from, let's say, the first of a kind financing to nth of a kind financing structures. So when we look at zero emission trucks, right, for us, the low hanging fruits are use cases which are around short distance or closed loop running, things like ports, uh, uh, say truck, cement plants, etc., or things which are amenable to corridor electrification. There is a lot of trucking which goes on specific road corridors, right? So both short, medium distance, and long distance. From us, when we are looking at financing tools, we need to address. I mean, I think you have in your report brought it out beautifully, but we would like to address the risk around how do we assure deployment, number one. Second, how do we assure the availability of charging during the route? And third, how do we address the battery changeover, which is needed during the life of the truck and often during the life of the loan? So we have looked at structures we have borrowed from both project finance and vehicle finance. From a project finance angle, you borrow typically deployment assurance, escrows, AMC extensions, and creating reserves or financing structures for battery changeover. From vehicle finance, you have to keep it simple because a lot of the operators, especially the smaller operators, would not really be amenable to project financing documentation or diligence, right? So there you have to go and say, hey, have you tied up all of these factors? And what if this risk happened? What if that risk happened? So we think loans with a assurance either from the OEM for a battery changeover or a built-in battery changeover feature would work, right? So that's a departure from the usual loan financing for heavy commercial vehicles. We also think there is a need for either project MES or a loan which allows people to sort of offer senior debt, additional uh, leverageability, right, above the equity which is being put in by the operator, because the usual operator, when they're buying heavy trucks, do not expect to put in more than 10-15%, whereas usual initial senior secured lenders do not want to fund more than 50 to 70%, right? So there is a gap there. Again, we have been working on project MES or loan lines to cover fleets, where we take the bottom layer and a senior lender takes the higher layer. And the last of it is leases. Again, we have been funding several lease providers over our journey. In lease providers, what is very critical to determine is most lease providers are passive in terms of risk management of residual value. Lease providers of things like laptops are not passive, they are active. So if you take that from a very small analogy to trucks, the lease provider for the truck has to handle the battery residual value. So they will need either tie-ups or they will need their own in-house capabilities to handle that. Otherwise, what happens is the risk transfers from the user to the lease provider, but the lease provider does not have the tools to handle it, and hence you go into a cycle which says, hey, this doesn't work. So I'm just pausing there. Otherwise, I may start repeating myself.
Thank you. Thank you so much for sharing all of these insights and highlighting some of these different financing models. Same question for Saurabh next. What innovative financing tools do you think can work to fund the deployment of first few thousands of sets in India?
Thank you, Samida. Am I audible?
Yes.
Excellent. So thank you, and thanks to the RMI team for having this webinar and for having me. And I think it's a very important question and a very important topic today. First of all, let me start with mentioning some of the obvious things. The trucking sector in India is an extremely complex ecosystem with different multiple actors involved in it, each of which most likely has a different or a separate commercial objective as well. And most likely the future is going to be of a multi-fuel, a multi-technology future. So it could probably be electric, it could be hydrogen, hydrogen ice. In the interim, we could see some LNG and other type of fuels, biofuels as well. And the very fundamental nature of trucking operations is that it is a commercial business, and that is probably something which differentiates it from two-wheeler, three-wheeler market, or probably even in some cases the STU buses that we have had experience as a country. And being a commercial market or a commercial nature, it's not just the TCO that we need to look at, it's also the affordability or the ability to repay the loans of the borrower that need to be looked at. Because borrowing for an asset which is 3x the capital cost of a diesel truck will ultimately impact his financing cost, his EMIs, and hence his bottom line as well, right? So that needs to be kept in perspective as well. Now, the Jan was talking about, just to take forward his point, there are probably 3 or 4 major areas or categories that we could segregate the operations for trucking. One is, of course, the urban fleet or the urban trucks that again has 2 different segments. One is your municipal fleet and second is your privately owned and operated fleet. Municipal fleet is either owned or it is contracted by the municipal corporations, and they are mostly small to light commercial vehicles that are operated in that segment. And that forms a very good candidate for doing a demand aggregation model. Probably, so when we talk about I'll just for a minute come back to your question of 10,000 trucks. 10,000 trucks could probably be introduced across different segments. So because we need to be sure of how each segment adopts a technology or technologies. So we could probably experiment or introduce pilots or scale the pilots in, say, municipal corporations. Then we could look at how the private players or the private operators for urban fleet can be sort of given access to low-cost long-term financing. Then the third type is the closed loop system. So they could be the factories and the manufacturing plants and port ecosystems, or inside the port or within the port to the CFS and back. Essentially, where we know about the vehicle kilometers, we can be sure about placing the charging infrastructure, and we can figure out utilization to a predictable sense. The fourth category would be the short haul or the regional trucking, which is probably a single day or an overnight journey. And that is typically about 250 to 300 kilometers. That is also the current range of battery electric trucks these days that we have available. The fourth is the long haul. So when we're looking at introducing initial trucks, 10,000 or 5,000, 20,000, any number of trucks, we need to try and introduce trucks across these different segments so that we can see how each of the ecosystem or the sub-ecosystems behave. And now coming to a question on financing. So the biggest challenge is to reduce the capital cost without relying too much on government subsidies. And the current PME drive has given about 500 crores, but at the end of the day, we all concur that it's a commercial business, so we have to look at other solutions for this as well. There could be probably, apart from what excellent points that Jack has made, and the business models in leasing and demand aggregation and ensuring batteries are also included in the AMCs, we could look at some kind of concessional financing. But that would not be only for the initial 10,000 trucks, that would probably be beyond those 10,000 trucks, that would be multi-year financing instruments. We could also look at some kind of probably, so I've talked about demand aggregation. Demand aggregation in certain cases might make sense, like in ports, ITVs, or even in urban scenarios. We could look at some sort of, as I said, probably climate financing or sustainability linked loans. Probably we could, but that would require a lot of working around on the ecosystem, developing the financing ecosystem in India. And I think these are the main things. Apart from this, the private sector will also definitely try to introduce its own business models, like Mari was talking about charging as a service, trucking as a service, mobility as a service. Then we need to probably look at the leasing models also. That is, I'm sure the private sector will do it. And I think that I will pause here for the minute, and then there are a lot of other things that probably I will talk about later.
Thank you so much for sharing different use cases and also sharing different financial instruments. I have several follow-up questions, but I'll get to those just in a little bit. But first, I want to hear from Samir in terms of his thoughts on what financing tools can work to fund the deployment of first 10,000 sets in India.
Hi, everyone. So I think, first of all, I'll probably, a lot of it has already been covered by the previous speakers, but I'll try to take a more practical approach to this. I think fundamentally, electric vehicles, and when we talk about trucks, it's a very, very new concept even today. So I think when we look at financing, the first thing is to really, be ready to take the risk on the new products. We really need to believe that this is an opportunity that can scale. This is the right opportunity, and that there is a problem that needs to be solved. I think that's the first. And principally, fundamentally, as financiers, we need to really have that strong belief. When we look at financing, I think the first aspect is about selecting the right product. So when we look at trucks, we need to make sure that we are looking at a product that fits the end use case. And especially with electric vehicles, we cannot have vehicles that are multi-purpose or can serve multiple use cases. Not today, at least, because you need to really have a very good ecosystem around those vehicles. We also need to make sure that these products are of good quality, and also that the products have the right cost as well for the end use case, because otherwise it doesn't work. And there are multiple ways you can think about products, and there are different types of products, different range of products, but also consider things like using of retrofitment products, which reduce the upfront cost substantially, and so on and so forth. So first is focus on the right product. The second is to think about leasing models. I think it's fair to say that fleet operators, given the nature of their business, would not like to own these vehicles, at least not initially. So we need to create leasing models, but leasing models also then mean that the lessor or the financing company is taking a much higher risk on the product. And therefore, they need to also therefore have a much deeper partnership with the manufacturers and other ecosystem partners to mitigate their risks. And the third aspect of this is performance guarantees. Now, performance guarantees one can see in many different ways. It could be like a credit guarantee scheme with that a SIDBI or the government does, etc. But I think beyond that, first the manufacturers need to own up to their products and say that this is what my product is going to deliver, and if it doesn't deliver, I'll take it back. Right, and you can do that in forms of having the right SLAs, having the right penalty clauses linked to the SLAs, have a buyback agreement, have residual value guarantee. So you can look at it many different ways. I'll also go on to say that it's not just about product performance; it's also about economic viability of the product. So if the product is not economically viable, why would a fleet operator continue running that product? So even in that scenario, at least for your first 10,000, economic viability also has to be a part of performance guarantee. Okay. So I'll stop there and we can discuss more later.
No, thank you so much for sharing different risks in the market right now and also sharing some of the potential solutions that could mitigate this risk. I have a question for Jen, kind of following up on the same theme. So Jen, the transition to zero emission trucks is definitely, there's no doubt that it is going to profoundly reshape the trucking industry, right? And it is going to offer substantial benefits when it comes to costs, when it comes to air quality, climate change. However, very similar to all the different emerging markets, this shift also is going to carry inherent risk. And some of these risks are already highlighted by Samir, as well as you mentioned some of them before. So what do you think are the key adjustments that industry players, such as fleet aggregators, charging infrastructure providers, OEMs, what key adjustments do these industry players need to make to create a bankable business cases for zero emission trucks? I think Samir already started on those lines in terms of the quality of the product, but I would also be curious to hear from your perspective what adjustment needs to be made in the system from industry side.
Sure. No, that's an important question, and probably this should have been the first question to everyone, because that's the genesis of financing, right? If the financier is not here to take over the world's risk, they're here to take over credit risks, right, and economic risk related to credit calls. If the financier is taking calls beyond what is the credit of the project, then you have to look at breakdown of what is leading to those, and is it fair for somebody else in the ecosystem to solve it, right? And if it's credit risk, then it's fair for the financier to solve it. If you take OEM downwards stack, right? So at the top of the stack sits the OEMs. Samir already highlighted a few points, right? We would want OEMs to first make sure. Stepping back, a truck is a battery rolled, a chassis rolled around a battery. So you just take you have to take the use case. You have to say this is the right battery pack for it, and then you have to wrap around the chassis around, not the other way around. You can't take something and say this is not a Swiss Army knife approach. This is a custom tool approach. So at this stage, most OEMs are still used to having product development cycles which are longish, and they're not really looking at saying that, hey, use case A I've got this battery. This is how the chassis gets managed. And you don't necessarily need to go and make it a full Walkman-like approach that you have a model coming out a week, right? But you need to make sure that for the use cases which are low-hanging fruit, you have the right truck. If you do not do this, you're creating the economic risk for the vehicle owner and therefore for the financier, and therefore asks for concessionality or asks for guarantee or somebody take away my risk come in, right? So first of all, I think there is a need to relook how truck form factors are being put out. It's not that people are not working on it. We have seen at least on the last mile, we've seen manufacturers respond to this. Needs to be more accelerated. Second, compared to, let's say, a personal car, the battery actually runs out fairly early on because of the nature of the trucks. Trucks chase miles. If you're going to drive a certain number of miles and you've optimized the battery size and you want a longer tenor financing, even a 5-year financing instead of a 3-year financing, the way the warranties are written, the warranties expire before the loan expires. Right? So we are asked as financiers to take calls which are 30% or 50% higher or longer than the warranty life. Right? So that's not fair. That's a problem which the OEM has to solve. So the warranties need to go to not the minimum distance driven in 5 years, but not the average distance driven in the 5 years, but let's say average plus 3 sigma or something, so that you are not looking at a situation where you're left holding the frame as a truck owner and the financier combo, and both are trying to pass blame at each other. Again, we have seen OEMs respond to this to some extent. Where more stuff needs to do because there is a mindset around how do I make sure the battery lasts that long? How do I make sure the frames last that long? Frames are designed to last longer, especially if the major OEMs are making it, right? And that's where we are looking at options of whether they offer a reasonably priced battery replacement option versus so a longer warranty versus an option which says for the next 10 years I keep changing the battery, but I don't charge an arm and leg for it. It's a fair number for it because cost curves are declining. So OEM should be in better position to take a call on it than a small fleet owner or than a regional financier or a smaller or a financier in one market. So I'm going to because that's what helps. I mean, having the right truck form factor, having the battery replacement cover, probably may just bring down your TCO already without any intervention to the sweet spot where you're saying, is it 3% better than diesel? Because you're not chasing all the use cases in the market, you're chasing specific use cases. And for those use cases, there is a 10% or 5% or 20% TCO advantage already before anything else is brought in. Right? That's what I mean by low-hanging fruit. Second, when we go to charging providers, they are already working on some ideas. They're looking at long-term contracts, stuff like that. One of the things which I've been advocating is specifically around major corridors, you could have a charging parking plaza approach where you create modular parking plazas where trucks can park overnight, stay overnight, charge, right? Because you don't want to charge a 400 kWh battery in 10 minutes, right? The cost of doing that on the battery and on the grid is tremendous, right? You also don't want a line of trucks spreading from here to the moon because they're waiting for a charging queue line to come up. Right? So a good approach for that is to create the plazas, and they have to be commercialized also. The land is scarce in cities, it's less scarce outside cities. And if you design it properly, it's monetizable. And that may pay for the cost of this. But as of this point in time, we have seen charging providers more responsive than OEMs to the need of this. But if you're looking to, say, electrify a corridor, right, Delhi to Kandla, you would need public policy intervention and a government intervention because it's infra being built. Right? The same way we build an expressway, we would build an electric corridor. In smaller routes, the charging providers can take care, private sector can take care. And when we look at fleet owners, again, for some, there is response already happening. They're coming to us with locked-in contracts for deployment, locked-in charging contracts, locked-in OEM AMCs, already demanding battery changeover loans to be built in, right? But that's a small percentage of the overall fleet operators. A lot of the fleet operators still sitting and saying that, hey, I have a truck today. Today it's going from Delhi to Kandla. Tomorrow it will go from Delhi to Guwahati. Right? That's not going to work. It has to be tied up. Once it is tied up, it makes money. The fleet operator makes the first life on the battery, changes the battery, and then they can potentially look at what kind of alternate deployments would be there. And they need to be creating deployment pathways, the contracts, so that if one goes down, the other can go up. Right? I mean, you can't assume that you are getting a government take or pay, government discount take or pay, or an NHAI annuity contract, right? These are deployment. So if there's demand, there would be, but there will be cancellation provisions. But there should not be casual walkaway cancellation provision. So that's something which the fleet operators need to do. It's a mindset change. We are seeing a lot of the startup-like fleet operators think this way. We are also seeing some of the second generation or third generation of older trucking companies. People think this way, but somebody who's just driving 5 trucks or standing, sitting outside the transport center is not necessarily ready for that. We are seeing some aggregators come in and start to play this role. A lot more needs to be done. So pausing here.
No, thank you. Thank you so much, Jayant. And thank you for highlighting different pathways for fleet aggregators, for charging infrastructure providers, and some shifts that industry can take place in order to de-risk the entire ecosystem. I have my next question for Saurabh. Saurabh, you spoke about concessional finance in your previous question as well. So concessional finance, and just for everyone's awareness, a tool that can offer below market rate funding from public entities as well as multilateral development banks. So concessional finance has played a pivotal role in advancing e-mobility transition for different sectors like buses and light-duty vehicles. From your background with World Bank and with your extensive experience in the whole electric mobility sector, what insights do you think can be drawn from these learnings about concessional finance to zero-emission trucking sector? And how do you see multilateral development banks such as World Bank contributing to the mobilization of finance for zero-emission trucking sector in India?
Thank you, Samita. Yes. So, see, the overall objective is to reduce the upfront capital cost of the asset, right? And concessional financing is one tool, and it has been deployed successfully in multiple projects across India, across the world by MDBs. And that can be one of the ways in which we can reduce the financing cost to give lending, which is below the current interest rates, right? The cost of capital is coming down. Having said all of this, I think there needs to be an overall kind of a long-term view that needs to be adopted here. Probably because I am now sort of probably moving forward from the earlier question where we were discussing only about the initial 10,000. Now it's about the entire ecosystem. So we need to take a view of across the entire ownership cycle. We are probably looking at only the first owners right now, but that is not the only market, and that is a very kind of a comparatively smaller market. Although the first owners would be the large service providers, the large fleet operators who might be the early adopters for this program. They might require concessional financing, and they already have access to the banking finance channels and various forms of equity and other hybrid instruments as well. The challenge will also come when the transition to the second-hand owner comes up. So probably we need to start thinking of those challenges right now. They may not need a solution right away, but that is something that the government and the MDPs and everybody needs to start thinking of, because the challenge in that segment is totally different. So if I talk about the first owner, probably the challenge is going to be having access to low-cost capital, low-cost financing, and the risk sharing may not be needed as much as was seen in a two-wheeler, three-wheeler market, because these borrowers already have a good credit history. The banks do not hesitate in giving out loans, although the challenge remains that currently the tenor of the loan is just 5 years, and that needs to be increased to 7 or 8 years. So a longer tenor loan plus a higher loan to value needs to be achieved for the first-hand owners. For the second-hand owners, the challenge is going to be about credit risk. It is going to be about basic access to finance as well. So in addition to concessional financing, there could be some sort of de-risking instruments that could be thought of down the lane when we come down to the second-hand owner market. And we need to encourage encourage the second-hand owner market, because otherwise the demand for the first owners will saturate at some point of time. And the third is the end of life. The end of life, that is the scrappage. We know the scrappage policy, India has a scrappage policy, but it has not been very effective. We need to look at how to sort of incentivize end of life trucks to sort of go in for scrapping and be incentivized for either cleaner trucks in diesel or probably some time down the line for electric or other things. The other could be probably be kind of, as I said, a de-risking fund or a partial credit risk guarantee instruments as well. And we could look at carbon financing. We could look at some other models of, say, blended finance as well. And the bank has held in other countries in the form of sustainability-linked loans, which are linked to certain environmental targets being achieved by the borrowers, and the cost of lending reduces as the borrower achieves the targets. And this has to be coupled with, as I said earlier, with policy interventions, like we need interoperability across charging across batteries and all. We also need probably more efficiency in the trucking logistics system as well. So, of course, Mari talked about telematics and other things that could go along there, and we need to see how these could be integrated at a national level, and how the borrowers could be incentivized to adopt these. And then down the line, probably climate financing or carbon credit mechanism, when it matures, we could look at that option as well. The plenty of options. I hope I've been able to answer your question, but if you have specific queries, I'll be happy to respond to that.
No, thank you so much, Saurabh. I want to follow up on similar lines with Samir. I think Jayant and Saurabh have shared multiple de-risking instruments, have shared more information on concessional finance, and ultimately it all boils down to unit economics, right? For zero-emission trucks to succeed, the unit economics must work, and fleets need to generate positive cash flow. High utilization rates in certain use cases are going to be key in identifying what use cases could be early adopters for zero-emission trucking transition. So I'm really eager to understand from you in terms of how these different factors impact the bankability of zero-emission trucks. So my question for you is, what initial use cases within the freight and trucking sector do you view as early movers with the ZET adoption? And how do you think different stakeholders can collaborate to ensure that these viable use cases attract necessary financing support for the
Sure. So I think, first we must look at who are all the different participants in this space. Of course, starting with the OEMs, then there are fleet operators, there's financing companies, there is charging operators, there's insurance, there's telematics, and there's service providers, meaning servicing of vehicles, etc. And then there'll be some other sort of infrastructure requirements, like what Jayant spoke about, having parking spots and things like that. I think all of this needs to be created in tandem, and therefore everybody needs to work together. This will provide both scale as well as mitigate a lot of risks. I think in terms of looking at use cases, of course, a lot of small trucks, light commercial vehicles are already becoming very, very popular. But I think from my perspective, I think the real game changer would be in utilizing zero-emission trucks for mid-mile mobility. And I think over there, the first thing that we need to think about is how do we ensure that the vehicles operate in a closed loop? What I mean by closed loop is that the vehicles need to operate on fixed routes. They need to have a clearly established starting point, end point, etc. We need to make sure these routes are chosen very carefully, based on the type of vehicle, the range of the vehicle, the charging infrastructure requirements. We need to have charging infrastructure that's available through the route, but also at the start point and the end point, or not very far from the start point and end point. And then of course, there needs to be a lot of, like I said earlier, also we need to ensure there's a lot of performance guarantees in place coming from OEMs. I think if we can bring all of this together, I think then that makes it very, very interesting for fleet operators also to be able to run these vehicles. I think the other areas that we need to think about is having very long-term agreements in place, both from a fleet operator perspective, but also having long-term lease financing options available, because the upfront cost is high. To make it economically viable, you need to really have long-term contracts. When you look at long-term contracts, obviously the risk of the asset keeps increasing substantially. So we need to also ensure that there's also enough protection in those contracts coming through AMC's extended warranties, but also through looking at what happens in case a battery runs out of its life. Do we incorporate an additional battery as part of the whole financing arrangement, and so on and so forth. I think these are some of the considerations, and of course, we should never overlook some of the sort of minor points. I'm saying minor, but it may not be as minor. Things like insurance. Insurance in the EV industry has been a huge challenge. First, to be able to get insurance, but then getting is slightly easier. Getting claims on insurance is very, very challenging. A lot of insurance companies still don't know what the rack rates of various replacement parts are for electric vehicles. So they don't know how to actually assess damage and replacements and process claims. So I think all of these things really need to be worked on. And if you're able to do it, I think it becomes quite viable. I think if we can look at routes, especially the mid-mile routes that take any product from a central hub to maybe a city hub, I think that's that kind of a route I would really like to see. I think that kind of a route is a fixed route, and I think that's where the biggest focus should be at the moment.
Well, thank you so much, Samir, and thank you for highlighting the critical use cases, including closed loop corridors, that can be the first movers when it comes to zero emission trucks. Some of the points that stood out to me from your answer right now were also with respect to the long-term contract and with respect to the total cost of ownership and utilization. So I'm curious to get Jen's perspective on it. Jayant, how does the need for long ownership periods to recoup the higher initial cost of sets affect financing strategies, in your opinion? And what steps do you think can be taken to establish and maintain the residual value for sets? Another point that Samir was mentioning.
Sure. So two parts to this. One, if you're looking at a truck, you have to first break it down into the two components, the glider or the chassis or the frame, whatever you want to call it, which usually has demonstrated lives of 10, 15 years, right? And depending on the use case, it's allowed to operate in certain routes for those time periods, depending on how much wear and tear has happened. I don't think that's a real challenge if it's coming from a mainstream OEM, but from startup OEMs, we do worry about that. And we have to assess that, okay, what happens, an equivalent example is you're driving a scooter and the handle breaks off, right? You won't expect that to happen with a major OEM. But with a startup OEM, it could happen, right? It could be how their manufacturing is evolving. When you take the battery for heavy trucks specifically, if you have optimized the battery to the deployment route, let's say you have a 10-year first life of the frame, which you assess. The battery will typically be changed at least once or twice during that period. So the battery residual value, we are looking at it, right? It's actually in second life. It's not in the truck itself. Meaning you need to make sure that the battery lasts the warranted period plus a little more, and then it changes over, right? And you need to make sure that the technology the OEM is given is enough for a new battery to come in there, right? You don't want to be paying arm and a leg for that changed battery, right? Which is where the OEM's role comes in. So the way we look at it is we always break our loans for the heavier vehicles into these two, the frame component and the battery component. The battery component pays faster and has a changeover component, and the frame component pays long. If you break it this way, it works. If it can be de-risked by an OEM assurance or AMC, it helps. It is a little early in the market for us to be figuring out how the second life happens, or because the trucks have not been deployed. But we are starting to look at what is happening on, let's say, two-wheelers, for instance. As of this point of time, most two-wheeler batteries are getting scrapped. They're not going into a second life application. They're too small, of a specific quality, etc. Even yesterday, I was walking through a battery factory, and their point was simple, that if the battery has a problem, the whole module has to be scrapped. So if a cell has a problem, right? Some of the cells are being made or put in a space because designed for mobility application, that you have to scrap it. And scrappage, we have recyclers in India, but that recovers very little value. So from a longer ownership perspective, you have to look at, okay, is the frame going to last 10 years? And is the battery going to change it? That should be sufficient for zero emission trucking. From a second life period or monetization period, I look at it as equity upside. So the bus owner, the truck owner or the bus owner wants to get the value out of the battery which is going out. Now, if that is taken as down payment for the next battery, good. If there is something left over, even better. Right? Worst is the battery dies, the warranty is denied, and there is no value. Right? If you have just destroyed economic value for a small truck operator, right? Somebody who has built up their credit record over 5, 7, 10 years, you are, for reasons outside their control, forcing them to walk away from a loan and not being able to get credit, right? That destroys livelihood. We don't want to go down that path. That's why you have to cover all of this.
Right. No, thank you so much for sharing that answer. I have a follow-up question for Saurabh. We have been discussing several different financing products at this point, but I'm curious to hear your perspective on how can blended finance and loan guarantee mechanism be effectively utilized to attract commercial investors and scale up the adoption of sets? And what unique challenges or what unique adjustments need to be made into these financing products, especially as we are applying those to zero emission trucking sector, a relatively nascent market as compared to the other two, three-wheeler sector, which has been more established at this point. So really curious to hear your perspective on it.
Sorry, by guarantee, you mean kind of a credit guarantee or a risk sharing facility or something of that sort? Or?
Yes, yes, like a risk sharing facility.
Okay. So definitely. So see, some of the countries have established specific funds for national funds for decarbonizing heavy goods vehicles. And that has been done in some countries in Europe, some countries in Africa have done it, some even in Latin America have done it. And they've all recognized that trucking the heavy goods vehicles, and probably we could expand it to the medium and the light good vehicles in India as well. It's at the end of the day a commercial business, and it needs to sort of finance its own operations and assets, right, without government support. So blended finance definitely can be looked at. There could be different models of blended financing. There could probably be, I'm just thinking about the national level decarbonization fund focused on decarbonizing the trucking sector, which with inputs from multilaterals from the government of India, from probably pension funds, which have long gestation periods, with even private players coming in, and that fund could then finance both the equity and the debt requirements as well. It could have financing through a range of instruments, probably junior equity, senior equity, probably mezzanine debt also, and it could even probably do a non-lending kind of an activity as well that we were discussing earlier in the presentation. So yes, there is a possibility, and we need to be innovative on the blended financing. And later on, we could have, say, green bonds or carbon financing. And in some of the countries, such funds have even been used to finance the upgradation for the OEMs as well, because OEMs also need an equal access to significant quantum of financing as well as low cost financing, right? So technology upgradation could be looked at the OEMs through these national level fund and or other instruments of blended financing. As I said, there could be sustainability linked loans also linked to special environmental targets, but the whole ecosystem in India needs to be developed along that. Coming to the second point, I will probably just keep it a bit short, and that's why I said in the beginning that we need to be careful of sort of carrying forward our learnings from the two-wheeler, three-wheeler market onto the trucking market, and need to really critically analyze whether a risk-sharing facility is even needed in the trucking sector or not. And there are 4 or 5 different risks that arise in financing of trucks. One is, of course, your credit risk. I'm talking from a lender's perspective, commercial bank. So one is, of course, your credit risk. Second is your technology risk. Third is your revenue or your market demand risk. And fourth is your resale value risk. Now, credit risk, if your borrowers are going to be large fleet operators with deep pockets, so they anyways have good credit history, and the credit risk right now in the trucking segment financing market is probably very, very low. It is just about, the NPAs are just about 0.6% or 0.7% or something of that sort. Technology risk, as both Jayant and Samira pointed out, we need assurances and warranties from different manufacturers, especially on the battery side, because the truck body and the chassis will outlast the battery much longer. So it's basically the battery that we should look at. Then remaining is the resale value or the residual value risk. Again, that risk arises mainly on the battery, not much on the truck. And probably we could look at some national level guidelines on residual value or something of that sort. But we need to, as I said, we need to critically analyze whether a risk sharing facility is needed for the large operators. Probably on the second-hand ownership market, we could require a risk sharing facility because the potential NPAs might be much higher. Again, I don't have the numbers, but probably the credit risk might be much higher. And probably develop some innovative financing tools for giving access to finance to the small fleet owner who has just one truck or two trucks or five trucks or maybe 10 trucks. So that is what we need to look at. The other last point I would like to make is there could be a kind of a perceived risk for the lenders, the banks, commercial banks, because right now they are used to a 4-year or 5-year loan tenure. But when we go down to electric or other zero-emission trucks, the tenure might be 7 years, 8 years or so, plus the risk of the battery is going to be there. So that perceived risk of a longer tenure, plus we need to look at how to give them comfort to increase the LTV is also something we need to do. So these kind of issues need to be addressed for finance.
Thank you for sharing that perspective, and also thank you for highlighting different kind of instruments and different kind of risks that they could address. I have a question for Samir, which kind of ties all of our discussion together. I think it is very clear that for successful financing, there is a strong need for creation of collaborative deal structures. So what kind of multi-stakeholder partnerships do you think are essential for this Z transition? And how can we effectively align different stakeholders from the start, from the get-go, to ensure that everyone has vested interest? So Samir, if you have any perspective on this.
Yeah, sure. I think spoke a little bit about it. I think we need to have a lot of different partnerships in place before we can actually even think about doing anything. I always believe that, especially in the electric vehicle space or any new sort of ecosystem that's developing, we must not think of ourselves as individual players or doing some individual tasks. So we should never think of ourselves as financiers only. Our role is more ecosystem development, and so is everybody else's role as well. Before we finance any vehicle, we need to make sure that whatever is required for the vehicle to stay on the road and whatever the driver needs, all of that should be available. Because unless that happens, there's just no point in financing a product. So be it having the right product, right service infrastructure, after sales support infrastructure, charging, having insurance, telematics, and also having the right commercial application for that vehicle. So all of that needs to be tied in before one can think about financing of a particular vehicle. Once that is done, then the next thing is, can the vehicle keep running? Is the uptime high? And what do you need to make sure that the uptime of the vehicle is high? Uptime depends on, obviously, after sales service support. It depends on your SLAs, also depends on quick, timely insurance claims if that's needed. Also depends on telematics to be able to observe how the vehicle is performing. If there's any deterioration in the vehicle, if there's a theft, retrieve the vehicle quickly. So all of these things essentially help in ensuring that the vehicle runs for most of the life. I think also one critical aspect is on when we talk about charging. I think when you look at calculating total cost of ownership, charging actually plays a huge role in that. Now, when we look at TCO models, different rates of charging are applied from 5 rupees to 25 rupees, right? So, and practically speaking, it's probably more somewhere between maybe around average 20 rupees, right? So, I think that also needs to be considered really well. How are we providing charging? Who's doing it? And is there enough charging facilities available to charge at a cheaper rate? Because I think over a 6, 7, 8 year period, and if the vehicle is actually being utilized, charging becomes the only big cost for the vehicle.
Right.
So I think all of these things need to just tie in together and to make it viable.
No, thank you. Thank you so much for sharing that final perspective. I want to be mindful of the time. I just have one last question, which is almost like a call to action. I would like to turn to each of our panelists for an actionable takeaway. And my question to all of you is, in one sentence, what is one crucial near-term action that is needed to drive the set transition, and who should lead it? So any call to action for any of our attendees, any of our participants over here, or the entire ecosystem, if you were to share one crucial near-term action to achieve the Z transition, and who should be responsible for it? If you can summarize that in a sentence, we'll also have some time for attendees Q&A. We'll start with Jayant.
Sorry, you don't ask easy questions, do you? So if I have to summarize it, one, I would like OEMs to solve the battery risk. That is the battery, shorter life of battery versus longer life of frame using the AMCs, right? So that I think will be a big factor for people to move. But I can't resist putting in a second one. You need the early adopter of takers to give in contracts. I think one of the questions in the Q&A was contracts are 3 years. We've seen 3-month contracts, right? So the contracts need to at least last the first life of the battery for the small fleet owners or medium fleet owners to start moving in this. So I'm pausing there.
Thank you, Jayant. Saurabh, how about you?
I think this needs the scale of complexity of the challenge requires a whole of the government, and I would say a whole of the ecosystem approach. So it's not just the government and different ministries that need to come together and implement policies, but it's even the private players. Like Jen was mentioning the OEMs. I would also add on the financiers, the operators, and probably the shippers. Everybody needs to be involved. The charge point operators, even the states also, when it comes to providing land for charging infrastructure, the electrical utility companies for providing assured electricity, etc. And everybody probably needs to come together to make this a success.
Thank you, Saurabh. And Samir, how about you?
I would just say, just do it. If you're a manufacturer, put a product out there, give a full guarantee on the product. If you're a financer, put at least one truck. If you're an insurer, insure at least one truck, process every claim that comes. I think unless we do it, we won't learn. I think we can sit and talk, build a lot of theories around it, but real learning comes from practical applications. So I think we should just go ahead and put some trucks on the road, take some learnings, take some losses if they have to be taken, and then rebuild it.
Thank you so much for offering that really insightful perspective. And I want to thank each of you for your insights and your time. This has been a very valuable discussion about the future of zero-emission trucking finance. Before we conclude, I would also like to open the floor for any questions from our audience, and I pass it off to my colleague Janan to help facilitate this segment for Q&A. Thank you so much again.
Thank you so much, Samhita, Jayant, Saurabh, and Samir for this insightful panel discussion. I have personally learned a lot from it. I see we're only having 5 minutes left, and our questions have asked a lot of interesting questions, and thanks, Jayant, especially for answering some of them already. Let's discuss this one question from Mr. Rajat around secondary market. So the question is around secondary market or currently lack thereof. The audience is curious to know if there is a scope to impact and accelerate the development of secondary market in India. Do we wait for the market to develop organically? And how can we advocate work here to push government agencies to support the second life application? Feel free, any of you, if you want to take on this question, feel free to come off mute.
So for ZEPs, it's premature for secondary market, as I had mentioned. But for smaller commercial vehicles, we are actively working with ecosystem players on the secondary market, including some people who would nominally be our competitors. We are basically trying to figure out refurbishment. We are trying to figure out battery residual assessment. We are trying to figure out putting in a new battery, right? And we are trying to figure out where does the old battery go to? Does it go into a static use or does it get recycled? So yes, it indeed is something the industry needs to work together, both the financiers, OEMs, and players in the ecosystem to encourage the innovators who are working in this area to create this ecosystem approach. We are hopeful that we would start funding, we would all start funding actively second life applications for the last mile virtual use cases. Some of those learnings would translate to trucking. But at this stage, since not enough trucks are in the market, we would need to first get enough trucks in the market, as Samir said, before we start working on the second line.
Saurabh, do you want to add to this question?
Yeah, so as I mentioned in one of my responses, developing the secondary market is very, very important for a long-term sustainable solution for zero-emission trucking. We need to, so let's just probably a few seconds, I'll probably just point this out. We need to put ourselves in a position of the second-hand owner who is making a purchase decision. He is going to be faced with a dilemma of everybody around him is talking about electric trucks or zero-emission trucks. He's heard people talk about it. He's heard they offer good economics in terms of operations. But that guy doesn't have access to finance, right? A lot of the second-hand owners finance trucks through borrowing from family, friends, and through their household savings, etc. They don't access the formal banking channel. So giving them access to finance, giving them access to formal banking channels and financing channels is one of the biggest issues. And if I again go back to my point, he's going to be faced with a question of whether he should scrap his old truck, go in for a used diesel truck or a used electric truck, or go in for a new diesel truck or a new electric truck. These are the four options going to be in front of him. And as things stand today and probably in the next few years, he will most likely go in for a used diesel truck. So, because again, when it comes to sale of electric trucks, the sale of electric trucks in the secondary market is going to be significantly higher than those of comparative diesel trucks. So there is no incentive for him to go in for a purchase of an electric truck in the secondary market when a much cheaper diesel truck is already available and he's already aware of how the diesel truck operates. So apart from giving him access to finance, the second challenge is going to be, like we were discussing earlier, low cost of financing. That needs to be carried forward to the secondary market as well, because you can't expect a person who doesn't have access to finance, he's given access to finance, but the loan is going to be at 15% or 18% rate of interest. So that is not going to make sense for him. That is the second thing that we need to look at. The third is we need to look at a gradual but sure transition to a kind of a formalization or at least adoption of technology among the second-hand market players that we were talking about, say telematics, we were talking about, say, track and trace, or maybe even having some comfort in finding subsequent loads. So otherwise he doesn't need to wait. Currently there's a statistic in India that about 40% of the trips are empty trips, and most of those trips probably are from the second-hand, the unorganized players. So when I talk about the second-hand market, I refer mainly to the unorganized players. Then probably some kind of skilling is also needed, and skilling is needed for the entire ecosystem, not only for the drivers, but also we need the maintenance, the entire ecosystem, because the current ecosystem doesn't sort of support, like we were talking about, having charging stations across highways. What if a truck breaks down? So we need to have that kind of a national level plan where the skill development or upskilling of existing players happens. And of course, I could talk a lot about it, but I will pause here for the interest of time. But yes, the need for a secondary market cannot be sort of underestimated for this.
Thank you so much, Saurabh. Samir, do you want to also quickly address this question?
Okay, sure. I think just very quickly, I think we can wait for the secondary market to develop organically, but that'll take 5 years. So I think we need to do something ourselves to build that secondary market. And there are many ways to build that secondary market. Again, that happens through partnerships. Now, secondary market can be seen in multiple ways. One is what happens if a vehicle actually comes back midlife, right? Because the operator is not able to operate it, etc. Over there, you build partnerships to basically redeploy the vehicle with other fleet operators. The vehicle can come towards the end of life, or vehicle can come back because of issues with product, battery, etc. So again, you need to be able to ensure that there are enough partnerships in place to make those changes, replacements, and then redeploy those vehicles. And finally, when they come back towards the end, I think we spoke about residual value guarantees earlier, but I think the idea is to make sure that the secondary value of the vehicle is higher than that residual value. Only then it makes sense. Otherwise, I think people are just going to lose money. And that will come again through looking at, can we reutilize the body of the vehicle? Can we create a secondary use case for batteries? And then how do we refit batteries on those vehicles and then redeploy them with either the same or the other fleets? So very quick response.
Thank you so much, Samir. And one more time, thanks again to all of our distinguished panelists for joining us today. I see we're at time, so just a quick final reminder that the session was being recorded, and you'll be able to find the recording at the RMI event page, which you used to RSVP for the event. We'll also be uploading the report link to the same page, so you can access the report. You will also be expecting an email from us in a couple of days, including information on how to access the report and how to download the recording. As Marie said, this report is just a beginning of the discussion. Finance is such a challenging and interesting topic, so we look forward to working with every and single one of you to bring this initiative forward. Thanks again for your time today. Take care.
Thank you.
Thank you so much.
Thank you so much.
Thank you.